morning, everyone. I'm Graydon Morris, Managing Director of Sterling Private Wealth. I'm sure all of you are sitting at home are highly concerned with the events in global markets over the last week or two, preempted obviously by material announcements by the US President relating to tariffs affecting global trade. There has, of course, been a significant sell-off in global markets, initially in the US, and that has spread to obviously emerging markets that prior to this announcement or the tariff announcements had actually been performing reasonably well year to date. Our message is always consistent to our investors. We have material liquidity in portfolios to be able to provide for any income requirements over the next 3 to 5 years. And the allocation to equity, both global and local, is of course long-term in nature, and patience and discipline should be applied. We cannot say with any certainty that the sell-off may continue beyond current levels, but my colleague and associate at Merchant West Investments, Ray Shapiro, will shortly be going through a presentation for you to give you an indication of the extent of previous drawdowns and rebounds from those levels. I think this will be instructive and give a great deal of comfort to investors. Ray will also discuss the performances of the South African equity market year to date and over the last 12 months, and it may surprise some of you that the performance of the SA market off the lows of early last year has actually been reasonably competitive relative to global markets. In addition to this issue, many of our fund managers, including the Merchant West Investments Global Equity team, have been defensively positioned, and the sell-offs in these positions has been materially less than that of the MSCI and indeed the very concentrated position in the S&P 500. Again, we believe this will give our investors a great deal of comfort. In addition, the global bond markets have been fairly resilient and have shown positive performance year to date, and this has offset equity declines. Without any further ado from my perspective, I'm going to hand over to Ray, who will take our investors and our clients through a presentation in terms of the global developments, the tariff developments, market performances, and fund performances.
Good day, everyone. My name is Raymond Shapiro. I'm the Chief Investment Officer of Merchant West Investments. Thank you, Graydon, for that introduction. We've certainly had some interesting few days in markets. In fact, the start of this year has been very interesting with what I would term Trump's tariff turmoil. I think what's interesting is just to look at what has happened both year to date and over the last year in markets. So if we look at the year-to-date performance, the S&P is in fact down almost 14% in dollars. Interestingly, the all-share index is only down 6% in dollars, so it's actually outperformed the S&P 500. The MSCI World is down 12%. Of course, a very high percentage of the MSCI World is invested in the US. And we've seen how China, after outperforming significantly, has started to come down with the rest of markets. If we look over the last year, another interesting picture emerges. In fact, surprise, surprise, the JSE All-Share Index in dollars is actually up 3.5%, despite the S&P 500 over the last 12 months being down approximately 3%. As we know, China has had a significant rebound in performance, still being up 16%. Although, as we know, markets have been falling rapidly over the last few days. The big question on everyone's mind is how likely is a US recession? Why do we focus on a US recession? Because typically if the US sneezes, the rest of the world catches a cold or even worse. So that is top of everyone's mind. So if we look at what is really driving recession risks at present, it's pretty much trade uncertainty. We've put up a graph here where it shows the trade uncertainty spiking. In fact, this graph does not take into account the last 2 to 3 days of Trump's tariff turmoil. So tariffs are not good things, despite what some people might say. They are inflationary. And the whole mode of, should we say, President Trump's approach to tariffs is causing significant uncertainty. And when there's uncertainty, businesses tend not to want to invest, and that can hurt growth. So tariffs are not really a good thing. Another important point is the wealth effect on consumption. So when markets go down, or in fact when property prices go down, this can feed through into consumption expenditure, especially in the US. The US consumer, in fact, on its own accounts for almost 20% of global GDP growth. And on the graph shown, we can see there's a very strong relationship between changes in household net worth and PCE, private consumption expenditure. So in a nutshell, when markets drop or house prices drop, this has a knock-on effect into consumption and can in fact cause a recession, especially given the fact that a significant amount of US investors' net worth is in equities, over 20%. So what are the probabilities of a recession? Last year, June, the probability of recession in the US was measured at over 70%. That is the bottom graph. Subsequently, the probability has come down. However, we see this probability of recession going up significantly, triggered by all this tariff turmoil that the US has unleashed on us. So we see that the probability of recession is being rapidly priced in by the markets, and one needs to be cautious in this environment. So how should investors react? Recessions are notoriously difficult to call, and to paraphrase the famous Peter Lynch quote, more money has been lost preparing for recessions and drawdowns often than in the drawdowns themselves. What we can see, the long-term trend of the market is up. Markets tend to recover post-drawdowns. It can take anywhere from 6 months to 2 years. The GFC was in fact slightly longer. However, that was very much an anomaly that was very different to the average. In fact, the average drawdown in markets since 1970, so that is the maximum, the drawdown from its previous peak, has been about 12%. We are currently at a 16% drawdown from the peak of the MSCI World. So we're a little bit more than the average of the last of the last 50 odd years, but it's certainly not out of the ordinary. And in fact, by other measures, if one looks at calendar years, the average, in fact, within a calendar year is closer to 14% drawdown. So this is definitely not out of the ordinary, and definitely no reason to panic. In fact, panicking at the wrong time and selling at the bottom can do a lot of damage to return. So we would urge investors to stay the course. We've run some interesting numbers, and it's a history of returns post drawdowns, and we've done it for the JSE All Share, the MSCI World, and the S&P 500. And what we find quite interesting is we've taken drawdowns 17% or larger. Of course, we picked 17% for the MSCI World because that is the current drawdown. The current drawdown, in fact, on the All Share is only 8% of its peak. And the S&P 500 is 17%. And what we see, let's take the MSCI World, where we're at 16%. The chances of you having a positive return, this is going by history, this is not a forecast, but historically the chances of having a positive return post a 16% drawdown in the MSCI World is 75%. And in fact, it's over 80% for the S&P 500. Post a 17% drawdown. So that is a very high historical probability of return. And typically those returns on the MSCI World in that 12-month period are in the order of 11%. For the JSE, they're in fact closer to a 16% post a drawdown of 8% or more. So we can see, and now is definitely not the time to sell, and very well may be the time to buy. So how are we positioned globally? Good question to ask a manager is not what his views are, but how he's positioned. I've taken our global equity fund, which is our flagship global fund, which tells you our thinking in many respects. We have been overweight defensive stocks. 35% of the fund is in defensives versus the MSCI World, which is 26% defensive. So we've been overweight defensive stocks for the better part of 2 odd years, and that is serving us very well in the current environment. If we look at our geographical exposure, we are in fact 65% North America, so that's by listing. The MSCI World by listing is 75% North America. So we have been underweight the US again for the last few years on various grounds. We are bottom-up investors. This is not trying to play politics. This is where we see the best intersection of value and quality. Another interesting angle to look at is where do companies make their money? So we've done a similar chart to the one before, but we've looked through as to where the underlying listed companies make their money. The MSCI World Index, 63% of the money is made in the US, and our current exposure is 57% to the US. So again, underweight US for the last while. How are we performing in our global equity fund? Obviously, the proof of the pudding is in the eating. Year to date, we have outperformed both the MSCI World and the peer group average, that's Section 65 approved global funds, and over the last year we've also outperformed the peer group and the MSCI World. If we look longer term, over the last 3 and 4 years, 4 years is the date from which I took over as the fund manager and implemented the quality strategy. That's why it's relevant. And I think we've performed well. Why have we performed well? It's basically buying strong quality companies, but being very cognizant of the price we pay. We want to buy the best companies at the best prices. So what could some opportunities be in the recent turmoil? What we've done is we've shown some SA equities, what their drawdowns are from their 52-week highs. Where could some opportunities be emerging? We see Sasol is down over 65%, Glencore down 50%, even companies like Truworths are down 45%, Aspen down 41%, even AVI, which is a typically very defensive, very well-run company, is 31% off its highs, and Investec down 27% off its highs. So opportunities are rapidly emerging. These are some very large drawdowns. If we look globally, where could some opportunities be emerging? We see Moderna is in fact down 85% off its 52-week high. Stellantis, which is obviously the car manufacturer, that's down 67%. Estee Lauder makeup, typically a defensive product, that is down 65% off its 52-week high. And we see stocks like Amazon down 28%, Nvidia down 36% off its high, and even Nike is down 43%. So we are seeing lots of opportunities emerging. Typically, this is when one wants to be buying, as Warren Buffett often says, greedy when others are fearful, and fearful when others are greedy. So we're very excited about a lot of the opportunities emerging. I think the key point is, because we are defensively positioned, we have the ability to take some of our profits off our defensive stocks and redeploy them into stocks showing significant long-term value. That's how we're seeing things currently. We're seeing lots of opportunities, and we would caution investors to take a long-term view. Thank you for your time.